Welcome to Mazuma headquarters today. It's a pleasure to be with you for our webinar. We're also celebrating our 6th birthday anniversary, so it's wonderful to still be in business serving great clients like yourself. So thank you very much for being with us today. Our webinar is meant to discuss some of the differences involved with being an LLC versus an S Corp. And really, what are the tax implications, the accounting and tax implications of each of those entity types? And then after we discuss that and see how the numbers shake out, what are some of the considerations that you should have in mind when deciding which entity type is right for you? Okay, so we hope you walk away with what's the tax impact, and what do I need to know before I make a decision. All right. Now, before we get into the numbers, I want to mention one thing. Did you know it's not possible to actually go out there and just form an S corporation right off the bat? You actually have to either start with an LLC or a C corporation, because the IRS doesn't have tax code for S corps. So they have tax code for C corps, they have tax code for LLCs, and then they allow either a C Corp or an LLC to become an S Corporation if they want. So step one is always form an LLC or a C Corporation, and then make an election to be taxed as an S Corp if that's what you decide is right for you. So LLC, here we are. We've got our pest control business. I've been running a couple years now. Sales are strong. We're going to post $100,000 of sales this year. All right? And let's say we've got $50,000 of expenses, which of course leaves us with a nice round $50,000 net income. All right? It's a good year. Now these are simple numbers, right? Big, round, easy numbers. And some of the tax rates that we're going to use today are simplified, but it's meant to drive home the concepts, okay? And the results that we see here are real, all right? They are the real results that we see happening every day with our clients, okay? So we got our $50,000 net income. End of the year comes, time for taxes. What does this look like on a tax return? Well, the first type of tax that we have to be concerned with, if we are an LLC, single member LLC, is the SE tax, or self-employment tax. All right, self-employment tax is the same as Social Security and Medicare taxes. All right, so it's just when you're not an employee, we call it self-employment tax. When you are an employee, we call it Social Security and Medicare tax. When you're not an employee, you pay all of it. When you are an employee, your employer pays half, you pay the other half. Okay? So in this case, we're the owner of our own LLC, we're not an employee. We're going to pay the full 15% of self-employment taxes on our profit. Okay? So that is $7,500. Boom, big heavy tax right there at the beginning. Next, we've got income taxes. All right, so the other kind of tax that of course everyone pays on all of their income. And for simplicity's sake, we're going to say this is about 10%. All right, so after you factor in all the itemized deductions, the kids and everything on $50,000, 10% is a pretty reasonable rate here. So that is an additional $5,000, leaving us with a total tax bill of $12,500. Okay, pretty hefty tax to be paying on just $50,000, but that's reality. So net income from a sole proprietor or LLC is subject to both self-employment taxes and income taxes, which approximate about 25% of your net, all right, in this scenario. All right, let's move on now to what it looks like with an S Corp scenario. Okay, we've got our same $100,000 sales. We've got our same $50,000 of expenses. However, now we have payroll and payroll taxes, because as we're going to talk about later, one of the requirements to being an S corporation is to put yourself as the owner and officer of the company, to put yourself on payroll. Okay, so the IRS expects you, as soon as you become an S Corp, you better be on payroll if you're putting any effort into this business and pulling any money out. All right. So a really rough rule of thumb, general rule to go by, is to make sure and pay yourself at least half of what your take home would be. Okay, without considering payroll. So in this case, our take home, our net income is the $50,000. So general rule of thumb, you pay yourself at least half of that through payroll. Okay, so you are getting paid a $25,000 salary throughout the year in the S Corp scenario. Okay, you're actually taking that money home. And on that $25,000, there are payroll taxes to pay, right? You've got the Social Security and Medicare now. And since that's coming out of your paycheck and it's being paid by the business throughout the year, it actually gets deducted on the business profit and loss. Okay, so that equals the same 15%. However, that 15% now is only applied to the payroll wage that was paid out. Okay, so 15% of the $25,000 is $37.50. Now, we're going to assume here, this is a little bit simplified, okay, because the employee is paying half of this and the business is paying half of those taxes. However, to demonstrate the overall cash flow, we're going to put the full 15% right there as a business expense. Okay, so in that scenario, we've got our net income of $21,250. All right, we've got our $25,000 that we've taken out as a wage, and our $21,250 that's left as net profit. Now I can take that net profit out as an owner's distribution. Now, okay, that's cash that's left over after expenses. It's not the same as having cash left over here in net income. S Corp net income is not subject to self-employment taxes. Okay, so it's available to take out as an owner's distribution. So let's go through the tax scenario here. What taxes do we have going on? Well, we've got income from our W-2 wage and income coming from our net profit from the S corporation. All right, to make a total of $46,250. Which is subject to income taxes, just like over here, the 10%. So 10% of $46,250 is $4,625 in income taxes. All right. So we've paid payroll taxes of $37.50. we've got income taxes of $46.25. No more taxes besides those have to be paid. Okay? We've paid our payroll taxes, our Social Security and Medicare is done. Our income tax is on the $46,250, $4,625. So when we add these two together, total taxes all in equal about $83.75, I believe is what that is. Interesting difference there, right? Same scenario, same dollars, same amount of money made, but here we've paid $12,500. Here we've only paid $83.75. That's a $4,000 savings, all right, just from being an S corporation. How did that happen? Well, we see that our self-employment taxes were only applied to the 25, our self-employment Social Security, Medicare self-employment taxes were only applied to the 25,000, not to the full take-home. Okay, and that's therein lies the secret of the S corporation. Really, that's really all it is. You're changing the nature of your income to taking some out as a wage and some out as an owner's distribution. And the way the IRS law sits, it says you only have to pay the Social Security and Medicare on the amount you pay out as a wage. Okay? So we're asking ourselves now, well, $4,000 savings, why wouldn't everybody do that? Right? Why wouldn't everybody just automatically do that every time? Well, there are some considerations. Okay, this isn't, the IRS knows about the tax savings that come up with an S corporation. And so there are some extra rules that they've put in place to make sure that you're jumping through the hoops, you're following all of the things you need to do to make it follow the law. All right? So let's move on over here to some of the S Corp considerations or extra rules and things you need to consider. So, first of all, the IRS has outlined a few specific requirements for S Corps. They've said S Corps can only have 100 or less owners, 100 or less shareholders. Okay, so obviously, all the clients that we deal with, that's not an issue. You're in not many cases are you going to have more than 100 owners. However, that is one of the stipulations. Next, all of the owners have to be domestic individuals. Okay, you are not allowed to have owners that are foreign, and you're not allowed to have owners that are LLCs or other entities. Okay, the rules say you can only be individuals who own it, who are living and residing in the United States. All right, so that's rule number 2. Rule number 3, one of the other major elements that comes into play if you've got multiple owners is the fact that this money that's left over has to be distributed in accordance with ownership percentages. Okay, so if I am a 75% owner of my pest control business and I've got a 25% owner helping me, I have to distribute this money. If I'm going to distribute it out of the company, I have to distribute it 75% to me, 25% to my partner. Okay, so whatever the ownership percentage is, that's the way the owner's distributions have to flow. Now I can still do a payroll. I can change payroll up and allocate payroll however I want to, but the owner's distributions of the net profit, which is where you're saving the self-employment tax or the Social Security and Medicare taxes, have to go according to ownership percentage. Okay? So that's our first area of consideration. Our next area of consideration is the concept of reasonable salary for the officers of the company. And this is the very gray area where the IRS gets a little bit scary sometimes with their opinion of what a reasonable salary is versus what your opinion might be. And there's no real solid, clear rules out there that you can just rely on. I mentioned a 50% salary rule of thumb. Well, that 50% is probably on the low end, the very lowest end that we would ever advise, but it's situational and it depends on your circumstances. But the IRS says the officers of the company that are working for the company need to take a reasonable salary, one that they might receive the same type of salary that they might receive if they were doing this job for another business, right? Or if you were gonna hire somebody to come and do what you do in your business, what would a reasonable salary be to pay that person? Okay, there's other, like I said, there's other factors and stuff, but that is an issue. You'll want to make sure that you're paying a reasonable payroll to yourself. And of course, it's pretty obvious why the IRS is concerned about that, because this is what they're getting the Social Security and Medicare taxes on, right? And they know it. So they say, well, that number has to be reasonable. All right, and because you have to put yourself on payroll and give yourself a reasonable salary, that means you need someone to do payroll for you, right? Which is often complicated. There's quarterly filings, there's payments all throughout the year that have to be done, and year-end filings. So you should consider the fact that you might have to pay somebody to run payroll for you and to take care of all of those taxes, okay, and keep you compliant. So that's it. It's kind of a two-pronged thing. You have to put yourself on payroll as well as pay for someone to run payroll for you. The other element that would allow you to meet the reasonable salary requirement is having a sufficient profit to justify putting yourself on payroll, paying for someone to run payroll for you, and still have enough left over to save taxes on, to not pay Social Security and Medicare. If my whole net, if I had expenses of $75,000 and I was netting $25,000, there may not be enough room in that $25,000 net profit to run a good payroll for me, pay for my payroll service, and save taxes. It may not make sense at that point. So having a decent net profit is a consideration. Okay. Lastly, the question of when's a good time, and what are the IRS rules about that allow you to do this? The strict IRS rule says that you have to make the S Corp election within 75 days of the end of the year, okay, which works out to be March 15th. And you are allowed to, at that, between January 1st and March 15th, you're allowed to file this election telling the IRS that you want to be an S Corp for the coming year. Okay, so they expect you to make this election in advance. That's what the initial rule, that's how the rule is written. But then they make a provision for a late election, which really then opens the window up substantially to allowing you to make this S Corp election on into the future, actually up to 3 years later. So it's very common to have late election requests, and we see those requests approved over and over and over again. It's most common, this time of year, October, fourth quarter time. It's very common to see a business owner in this situation, and in the LLC situation, where they're looking at this self-employment tax coming down the pike and realizing, oh gosh, that's too much. and maybe their business is growing, and so they know it's only going to get worse. And so they're wondering, can I make the S Corp election now? And so the answer is yes. Here in October, November, you can make the S Corp election. You can get it approved. You can get your payroll started before the end of the year and run $25,000 through payroll, pay all the taxes in, and and file the payroll tax returns and be compliant. And then at the end of the year, you've got an S Corp tax return and your personal tax return, and it all works. All right, so that's kind of the timing from a IRS rules standpoint. You prepare the election, and filing an election sounds complicated, but it's really just a 2-page form. That the first page is your business name and address. The second page is a list of all the owners and the fact that they are stating that they want to become an S Corp. All right, so and then you just fax that into the IRS, wait for the letter to come back that approves you. All right, so it's a very simple election, and it's not very complicated to get done, and there's very rare to ever see it rejected. So that's the timing, doing it before March 15th, or if you're after March 15th and trying to do it for the prior year, or for you're after March 15th and trying to do it for the current year, filing a late election, which involves just a little bit of extra verbiage in the election form. The other element of timing kind of involves what we discussed earlier. If your profits are $50,000 or less than $50,000, you might want to start considering. And if they're shooting up, then this is if you have taxes in mind, and if all the other considerations are met. But if you're looking like you're approaching $50,000 and you're going to blow past it with your net profit, from a tax perspective, it's a real. We often advise at that point to start considering the S Corp election and planning for that, because cash flow, it just ends up saving you a lot of taxes. All right, so there's our last 2 considerations. We hope that this information, the demonstration of how the taxes work, and the savings that can be realized with an S corporation if it's right for you, and that these considerations have given you the information that you need to at least know the right questions to ask, right? Know the right questions to ask yourself, or to ask a professional, or to call us here at Mazuma and ask, so that you can be wise in your approach to taxes and ensure that you're paying as little as possible, yet following all of the IRS rules along the way. Hope you find the information valuable. We'll see you next time.